If you're 65 or older and you have money sitting in a savings account, GIC, term deposit, or another bank account, there's one important rule you should understand in 2026. Because the money in your account may not be the only thing that matters. The interest that money earns can affect your taxes, and depending on your overall income, can also matter when certain government benefits are calculated. And this is something many Canadian seniors overlook because they think, it's my savings, so why would the government care? The important point is that the government generally is not taxing you simply because you have money sitting in a normal bank account. What matters is the income generated by that money, such as interest. The Canada Revenue Agency says interest and other investment income generally must be reported as income, and even if you do not receive a T5 slip for a small amount of interest, you can still have to report it. So today, I want to explain this in very simple terms, especially for Canadian seniors receiving or planning to receive OAS, CPP, GIS, or other retirement income. There's no need to panic, and there's no reason to move your money simply because you heard that banks report everything. Instead, you need to understand what information your financial institution reports, what you personally have to report, what interest income means, and why the difference between a regular account and a TFSA can be so important. This video is educational, so always check your individual situation with the CRA, your bank, or a qualified tax professional before making a financial decision. Let's start with the most important clarification. Having money in a Canadian bank account does not automatically mean that the CRA is going to tax the entire balance. If you have $20,000, $50,000, or even more sitting in a regular savings account, the balance itself is not suddenly treated as taxable income just because you have it. The issue is generally the income that the money produces. For example, imagine you have $50,000 in a regular savings account, and during the year, that account earns $500 in interest. The $50,000 is your savings, while the $2,500 is investment income. CRA guidance says interest income must generally be reported, including interest paid or credited to bank accounts. And this is where the one bank rule becomes important for seniors. Don't look only at your bank balance. Look at the income your bank balance is generating and how that income fits into your tax return. This becomes especially important when you have several accounts. Maybe you have a checking account, a savings account, a GIC, and an investment account at different financial institutions. Individually, each amount of interest may look small, but when you put everything together, the total investment income can become meaningful. Your bank or financial institution may provide tax information such as a T5 for eligible investment income. CRA explains that T5 slips are used for certain investment income, including interest from non-registered accounts. Now, here is something many seniors get wrong. They sometimes believe that if the bank does not send them a T5 because the amount of interest is small, they don't have to report it. That is not necessarily true. CRA specifically says that you may not receive a T5 if your total investment income is less than $50, but you still have to report the income. So if you earned $35 of interest and there's no slip sitting in your mailbox, that does not automatically make the $35 disappear from your tax obligations. Why does this matter so much after age 65? Because retirement income can come from several different places at the same time. You might have CPP, you might have OAS, you might have a workplace pension, you might have RRSP withdrawals or RRIF income, you may have investment income, and you may have interest from savings accounts or GICs. Each individual source might look manageable, but together they determine your overall income situation. This is particularly important if you receive GIS, because GIS is designed for lower income OAS pensioners, and eligibility and payment amounts depend on income. That means seniors should not casually assume that investment income is irrelevant simply because it comes from savings they accumulated over many years. A small amount of additional income may not make a dramatic difference, but you should understand how your total income is calculated before making decisions about where your money sits. Now, let's talk about one of the biggest areas of confusion: regular savings accounts versus TFSAs. A regular savings account can generate taxable interest. The Financial Consumer Agency of Canada explains that interest earned in a regular savings account is generally taxable, while interest earned inside a TFSA is not taxed, and withdrawals from a TFSA are generally not taxed. That does not mean every senior should immediately move money into a TFSA. Your circumstances matter. But if you have eligible TFSA contribution room, and you are holding money in a taxable savings account simply because you have never reviewed your options, it may be worth asking a qualified professional or your financial institution whether a TFSA makes sense for you. And there is another important point. A TFSA is not the same thing as a regular savings account just because both can hold cash. The tax treatment depends on the type of account. If you have $30,000 in a normal taxable savings account earning interest, that interest can generally be taxable. If you have eligible savings or investments inside a TFSA, the investment income and withdrawals generally receive the TFSA's tax treatment. The account structure matters. Now let's move to GICs, because this is another place where seniors can get surprised. Many retirees use GICs because they want predictable returns and do not want the same level of market risk associated with some investments. But you should not assume that because you haven't physically received the interest yet, there is automatically no income to report. CRA explains that interest on certain term deposits and GICs can accumulate over time, and in many cases, the interest has to be reported for each complete investment year, even if you haven't received the cash yet. For example, imagine you purchase a multi-year compound GIC. The bank doesn't send you monthly interest into your checking account. Instead, the interest stays inside the GIC and compounds. So you might think, I haven't received the money, so there's nothing to report. But CRA's guidance explains that for certain GICs and similar investments, interest earned during each complete investment year can still need to be reported. That is why I strongly recommend that Canadian seniors keep their bank statements, GIC documents, investment statements, and tax slips organized. You don't want to reach tax season and suddenly realize you have several different financial institutions and no idea where your investment income came from. Now, let's discuss another issue that can cause confusion: joint bank accounts. Many older Canadians have joint accounts with a spouse, adult child, or another family member. Perhaps the account was created for convenience, estate planning, or to help someone manage bills. But simply putting two names on an account does not automatically mean that both people can ignore how the interest income is reported. CRA guidance says that, generally, interest from a joint bank account is reported according to each person's share based on how much they contributed to the account. This is extremely important because seniors sometimes add an adult child's name to a bank account for practical reasons without thinking about the tax implications. If you have a joint account, don't automatically assume the person whose name appears first is responsible for all the income, or that the interest can simply be split 50-50 regardless of who contributed the money. The actual circumstances matter. So if you have a joint account, especially one containing a large amount of retirement savings, this is a good time to review the arrangement and keep records showing where the money came from. If there is any uncertainty, speak with a tax professional. Now let's address the phrase that creates the most fear online. The bank is watching your account. Seniors sometimes hear claims that if you have a certain amount of money in the bank, the government automatically takes it away, or your benefits suddenly stop. Be very careful with these claims. A bank account balance is not automatically a tax bill, and there isn't a general rule saying that every Canadian senior with more than some magical dollar amount in a bank account loses their OAS. The more useful question is, what type of money is it? What income does it produce? And how does that income affect your overall financial and tax situation? That's a much more accurate way to look at it. There's also a difference between reporting information and owing tax. Your financial institution may provide information to the CRA about investment income. That does not mean the CRA is automatically taking that entire amount from you. Reporting simply means the income is properly reflected in the tax system. Your actual tax outcome depends on your overall circumstances, deductions, credits, and income. And this is why you should not panic if you receive a T5. A T5 is not a warning letter. It is a tax information slip showing certain investment income. The CRA explains that interest from Canadian sources can appear on a T5 and is reported as investment income on your tax return. Another important mistake is forgetting about small accounts at different banks. Let's say you have $8,000 at one bank, $12,000 at another, and $5,000 in a third account. You might think each account is too small to matter, but the interest from all of these accounts still forms part of your investment income. Your tax return looks at your overall situation rather than whether one particular account feels significant. This is also why seniors should be careful when comparing interest rates. A higher rate can be attractive, but don't look only at the advertised percentage. Ask what type of account it is, whether the rate is promotional, how long the rate lasts, whether the account is registered or non-registered, and what the tax treatment is. For example, if two accounts offer different interest rates, the account with the higher advertised rate isn't automatically the better choice after considering taxes, access to your money, fees, and your personal financial needs. Now, let's talk about OAS and the possibility of an OAS recovery tax, often called the OAS clawback. This is another reason why understanding investment income matters. OAS recovery tax is based on income, not simply on how much money you have sitting in your bank account. So having a large savings balance does not by itself mean that your OAS is automatically clawed back. But taxable investment income can form part of the income used in determining whether the recovery tax applies. This is a crucial distinction. You could have a substantial amount of savings but relatively modest taxable income, depending on how those savings are structured. Another person might have a similar amount of assets, but considerably more taxable income because their investments produce more interest, dividends, or other income. So if you are approaching retirement or already receiving OAS, don't just ask, how much money do I have? Also ask, how much taxable income are my savings generating each year? That is the number you should understand. And now we come to a simple 2026 checklist that every Canadian senior can use. First, check every bank account you have, including accounts you rarely use. Second, check your GICs and term deposits. Third, check whether you received T5 slips. Fourth, compare the slips with your own statements. Fifth, make sure interest income has not been forgotten simply because the amount was small. Sixth, if you have joint accounts, make sure you understand how the interest should be allocated. And seventh, if you're receiving GIS or are concerned about OAS recovery tax, understand how your total income may affect those benefits. Remember, this isn't about being afraid of your bank. It's about being organized. One of the best things you can do as a senior is to create a simple folder, physical or digital, containing your bank statements, GIC certificates, investment statements, T5 slips, pension documents, and other tax information. When tax season arrives, you can review everything instead of relying on memory. CRA's 2026 tax guidance also reminds taxpayers to make sure they have the necessary tax slips and documents before filing. And there is one final warning I want to give you. Do not move your savings simply because somebody on social media says that a new 2026 bank rule means seniors are going to lose their money. Before transferring a large amount, closing an account, breaking a GIC, or changing your retirement strategy, verify the information through official Canadian sources or speak with a qualified professional. The banking system, tax rules, and government benefit programs can be complicated. Viral videos often turn a small tax or reporting rule into a dramatic headline. Your best protection is understanding the actual rule. So, if you are 65 or older, remember this simple sentence. The important thing is not simply how much money you have in the bank. It's understanding what type of account you have, what income that money generates, and how that income fits into your overall tax and retirement picture. Your savings represent years of work. You deserve to understand how they are treated. And if you found this information useful, make sure you stay connected, because in our next videos we'll continue breaking down important Canadian retirement rules, OAS, CPP, GIS, taxes, and senior benefits in simple language, without the confusing financial jargon. One small mistake can sometimes create a big headache, but one simple review today can help you avoid surprises later. Thanks for watching.